And I will ask Jack Noonan to come and take over and guide us through the next panel. Actually, I'm very happy to see that it's the first time we're having a chemical tanker sector panel. We usually have in the past crude tankers, product tankers. Now we're having a chemical tanker sector panel. So I'm delighted to be able to host this panel. And I'm also delighted, of course, we have the great panelists, but I'm also delighted to have Jack as the moderator. Couldn't come up with a more expert moderator than Jack Noonan. So thank you. Very well. So you have the countdown clock down there.
Countdown clock? Okay.
So please keep the time.
I will. No problem. Good morning. Almost afternoon here. There's the countdown clock. This is the speed dating version of the finance conferences. So we're going to keep to our 35 minutes here. So I'll keep the introductions very brief. I'm Jack Noonan, former CEO of Chembulk Tankers, founder of my own consulting company, Binnacle Maritime, and director with Borelli Walsh, which was the firm that did the corporate insolvency restructuring of former Chembulk parent Burley and Lejeune Tanker. On the panel, we have here David Wiswell, the recently appointed COO of Navigate Chemical, and former colleague of mine from Chembulk. Bjørn Kristian Røed, Manager of Investor Relations and Research at Odfjell, one of the largest chemical tanker owners in the world. And Kevin Kilcullen, CFO of Team Tankers. Their bios are in the program. They're very impressive bios, and I request you to have a look at it. So we'll kick it off here. I've been in the chemical tanker business for 30 plus years, and I've always enjoyed it. I've found it to be fascinating. Bjørn, let's start with you. What's your outlook for the future of the chemical tanker business? What are the main drivers?
Yeah, dividing that into long-term and short-term. Starting with the short-term, I think we are seeing for the first time, maybe ever in the chemical tanker business, that is actually changing quite rapidly. It is a new structural shift coming into the market, the way we see it in the short term, but also in the long term. And that is the U.S. shale revolution, making the U.S. going from a dinosaur in the chemical industry to become a net exporter starting from this year of many key products and also into next year. And then you have the Middle East, where we are going into large investments into vertical integration, maximizing the value of the barrels. We're seeing massive build-outs of plants that are export-oriented, where you will double and triple the distances for many of the key chemical products out there the next couple of years. Looking at the long term, we do carry kind of the building blocks of the modern society. Looking at IEA and other researchers, we're seeing 3% demand growth in the long term for chemicals. Refined products, 0.5%, of which a large share of that will go into production of petrochemicals. IEA last week had a report out saying that 50% of the world oil demand will go into chemicals over the next, by 2050, and 30% of oil demand will go into petrochemicals by 2030. So I think the stars are aligned for our segment, and I think the very short term is extremely exciting, and it's really, we are entering into uncharted territory.
What about the impact of, the increasing price of oil? And you touched on the Middle East infrastructure. What kind of change does that have on ton-mile demand? Historically, U.S. Gulf was always the biggest supplier of petrochemicals, especially the petrochemical feedstocks, like the upstream chemicals, as opposed to the downstream, more specialized.
The interesting part about the U.S. and the shale is that it's gas-based chemicals. We're seeing, the Henry Hub is disconnected from the oil price. We're seeing these investments being made since 2010, entering the market, and then because they have a huge competitive advantage versus China, for example, the world's largest importer of chemicals, that is reliant on crude-based feedstock. So what we're seeing now is that the Koreans and the Japanese are not able to compete with the US producers. And we also see also large investments in China that is based also on naphtha and crude input, having a hard time competing with the US based on their feedstock costs. So the oil price in general, when it has moved upwards, it's really in the favor of increased long-haul shipments.
David, anything on that?
Yeah, I mean, I think the same can be said for the European refineries as well, as they're crude-based. So I think while you have the Middle East being a supply center as well as the US Gulf being a supply center for China, I think the US and Middle East are also going to be seeing increased exports to the European market as the increase in oil price increases their energy cost and makes them less competitive relative to these two new production centers.
Thank you. The ship owners up here, their fleets go across the full gamut of chemical tankers. Unlike the commoditized tankers, crude VLCCs, Aframaxes, Suezmaxes, and product tankers, you get the MRs. When you say chemical tankers, there's a vast range. We have, the commodity chemical tankers, which are nicknamed chemical MRs, all the way down to, in my day, we called the drugstore trade. Now they're calling it super segregator. So this is a toss-up. What do you think is the future? The long-haul, commoditized, larger volume commoditized chemical feedstocks, the upstream feedstocks, or the downstream specialized chemicals that move in smaller lots that require greater sophistication? What do you think the balance is?
Yeah, I could say our DNA in Odfjell, we are a parcel tanker operator, and that's what we've done since we kind of started this business in the 50s. When it comes to growth going forward, I think there's going to be plenty around for all of us, and I think for us it will always be kind of an optimization game. That if we do not make healthy returns on the specialized smaller parcels, I mean, of course, then we will move into more of the bulk chemicals, and I think basically the short answer is that it will be correlated in a way. So I don't think the parcel tankers or the bulk operator will be much better off than the others. Yeah.
I mean, for Navigate, we're certainly more focused on the commodity, the larger volume sort of commodity chemical movements. I think a significant amount of the demand that's coming from China, methanol being sort of one headline example, with the methanol to olefin plants, which are production facilities that are ultimately the feedstocks for the sort of key consumer goods, is an area in which we're focused. So I think as that area continues to grow versus some more specialized products, which I think is a more mature market, we see the opportunity to capture sort of incremental growth and volume in the more commoditized chemical movements.
Okay, Kevin, you're not getting off the hook here. So when it comes to the cargo mix, what's your opinion on producer cargoes, the big chemical and oil companies with their contracts of affreightment, and the commodity traders with their spot movements? And is there an ideal balance there?
I don't think there is an ideal balance, and it really depends on the asset mix of the vessel owner. If you have a business like Bjørn's with highly sophisticated ships that need to carry a bunch of different cargoes, you probably need a base of contracts to ensure a trading pattern to fill those ships. If you have less sophisticated vessels like myself and David, you can mix in a fair amount of spot volumes. As you know, you'll be trading mainly point to point and doing much fewer parcel business. I think the COAs provide some downside protection in a falling market, but pricing resets every year, maybe every 2 years, so it's not long-term price protection. It's more of a guarantee of a trading area than a synthetic time charter cover.
And what about the fleet makeup, as far as the ownership makeup, I should say? I've worked for 4 different shipping companies, and it was always owner-operator. What's your feeling about employment of tonnage, and this is actually for anybody, employment of tonnage via time chartering out to the oil majors, chemical majors, any cargo shipper versus chartering out to a competitor, a tonnage operator that may prove to be your competitor. Any opinion there?
I mean, I think the 3 companies on this panel all have pretty sophisticated onshore organizations to fix their ships and create a cargo book and optimal trading patterns for their fleets. We will fix the ship out on time charter on occasion, but that's more of an adjunct to a customer relationship. If there's a big COA customer in one region, we might give them a time charter ship so that they have the appropriate exposure on the tonnage side going forward. But as a general rule, we feel like we create value by operating our ships, and therefore we don't want to give that away to somebody else.
I agree with that. Anybody else?
Yeah, from our side, we have 60 to 65% COA coverage on our vessels, and we own the larger sophisticated super segregators ourselves, and also the larger stainless steel tankers. And then we have sort of a 50-50 approach on time charter in, and that's important for us to kind of flex our vessels and the opportunities in the market as they arise. If the market is weak, we will redeliver tonnage, and if we see the opportunities, we will take them in on charter again. So we do, and we will continue to do that, I think. And for example, now with our new buildings, with our growth and what we've done on the consolidation side, we have actually been replacing those new vessels with older and more expensive time charter in tonnage. So.
And I would think the intrinsic use of capital plays into that as well, owning versus time chartering, or new buildings secondhand.
Sure, and for the the 19,000 tonners, there's a fairly liquid time charter market which you can play, so we don't have to own them.
David, this one's for you. I had thought about addressing the impact on trade, because that's what we're talking about in this part of the session. What do you feel the impact of the Trump administration's policies are? I will say that there was an entire session on that earlier today. I wasn't here, but I was wondering if you wanted to comment that with any specificity to the chemical tanker trade.
I mean, I think it can be broken down into short-term impact that I think has already happened and potential longer-term impacts. I think the short-term, looking specifically at China with ethanol being a key trans-Pacific cargo, I think the sort of scepter of potential tariffs against specific commodities impacted the actual trade before the commodities were actually being moved and the tariffs were being implemented. So I think while that might be more of a trader mentality, I think when you look towards the longer term impacts and what's happening relative to the viability and the sustained growth within the chemical tanker market, it's looking at a lot of the plans and planning stages that the petrochemical plants in the US Gulf particularly are in right now. If the trade war continues, it becomes a protracted problem between China and the United States. I think there's the possibility for some of those petrochemical plants in the studies that phase that they're in right now to be scrapped because the economic viability is no longer there.
Yeah, and in wrapping up on the trade portion and tying in 2 of the last questions, having spent the amount of time I did in the chemical tanker sector, what I will say is that I've always tried to describe it to the layman as a cross between tanker trading and the liner trade. So what you were saying about the COA mix, which I fully support, I've always kind of targeted the 50-50 mix as a target with a plus or minus 10% swing depending on freight rates. You really need that for the rateability of establishing trade lanes. And as far as the tariffs and such, You know, in the book, 90% of everything moves on the water in some form or another, and the petrochemical feedstocks, much of which go into production of plastics and fibers, ultimately ends up as you know, consumer goods that we use every day in the automobile industry, housing, etc. Any comment on that, or?
Yeah, I mean, I think it's globally. You look at the growing middle class. The middle class is ultimately going to be the consumer of the goods or the end products that are made with the petrochemicals that we carry. So while I think China is an important market, you look at India, you look at Latin America, and ultimately, you know, Africa at some point. It's a diverse array of areas in which you're going to see demand for these products that we're using. So I think there is opportunity across regions and globally for growth within the space and new markets to continue to grow.
Okay, thanks. This wouldn't be a proper shipping conference without addressing that 800-pound gorilla in the room, consolidation. I know that there's a panel devoted to this right after lunch, but specifically within the chemical tanker sector, there have been over the past 3 years, two major consolidations. Stolt-Nielsen's acquisition of Joe Tankers, which both Odfjell and Chembulk were involved in. We made the final three. And also, most recently, Team's acquisition of Lorin Maritime. So, who would like to address the topic of consolidation and the very fragmented chemical tanker sector?
Jack, I got very nervous there when you said 800-pound gorilla. I thought this was an IMO 2020 question. So, consolidation's much easier to discuss. As Jack mentioned, we completed a $210 million deal in April, added about 15 ships in a very sophisticated, high-quality onshore operation to our business. We continue to think consolidation will drive the chemical market going forward. I think there are many reasons why chemicals in particular is a much more suitable segment for consolidation when you look across shipping, in part because it is a more inefficient business. There are heavier onshore organizations, there are more port calls, there are more cargo operations. All of these things improve with scale, and we've certainly seen that in our acquisition where we were able to dramatically reduce the combined cost base of the two companies. We think that creates real value and should continue to occur in the future.
Yeah, I mean, I totally understand the operating synergies there and the operating benefits, but if it's so good, why hasn't it happened? What are some of the impediments?
I think from Odfjell's side, we've done two transactions. We took control over CHEMS fleet, a new entrant into the market. We also took Chemical Transportation Group out of the market. And I think going back when we were looking at consolidation targets, it was CHEMS and CTG on top of that list. But beyond that list, there were not that many. And that's, for us, we need to find that fit. And I think there are many companies out there with attractive assets, but they're also on a wide variety that doesn't necessarily fit our platform today. So it's not necessarily just to pick a vessel and see that, hey, we're consolidating, but we're actually just entering into a new type of trading our vessels.
I think there's also still a lot of family ownership in chemical tankers, particularly globally. When you look at regional chemical tanker operations, there are family-owned, long-term owners that might not necessarily be looking for a combination. They're looking to pass the business down to the next generation. So they have a motivation that's not the same as maybe the public companies represented here.
Yeah, I was going to say that too. I just think the differences in ownership structure, you know, public, family-owned, private equity-owned, that in and of itself creates an impediment that needs to be overcome. What about tonnage supply? We were talking about, Bjørn, you were very eloquent in speaking about the demand. What about tonnage supply? David, you want to address that? New order book?
I think it's really twofold. First, looking at the chemical tanker order book, right now it's at historical lows relative to where it's been in about the past 20 years. It's about 9%, give or take. averaging probably about 29% over the last 20 years. Obviously, a lot of that coming in, say, the 2012 to 2015 window when there were a significant number of new builds being ordered and delivered. So I think it's taken a significant period of time for the market to really sort of digest that additional tonnage that was coming onto the water. I think furthermore, you're seeing constraints or a bottleneck in the actual abilities for these yards to build. So if you were to order a stainless ship in Japan right now, you would be looking at about a 2+ year lead time until the vessel is to actually hit the water. So in terms of sort of the immediate runway and sort of a supply side shock, there is that bottleneck that I think is going to prevent that going forward. I think the bigger issue, or say an issue on top of the underlying one, is the product tanker market. I think when you're looking at MRs and this sort of dearth of orders that came in during the same period as those chemical tanker orders, there was not enough cargo to fill those ships necessarily. So I think they sort of became more agnostic about carrying chemicals or carrying CPP. So when there was sort of that indifference relative to the cargo that they were moving, the fleet was artificially growing in a way that was increasing competition just beyond the core chemical tanker fleet. I think we're seeing the supply side, it's about the same, about 9% now as well for the product tanker in terms of order book to current fleet. So I think there's a lot of promise in that sector as well, and that sort of cannibalization that was happening between the two is starting to abate somewhat, which should be positive for the sector as a whole.
Yeah, thanks for that, David. I would also say that in the chemical tanker trades, one of the largest ship profiles is what's referred to as a J19, a 20,000 ton or a 19.9 officially built in Japan, stainless steel. And this is a phenomenon that only really started at the beginning of this century. So you have ships that are 18 years old. You got to wonder that ships that in 2020 are going to be 15 to 20 years old, does it warrant investment of the ballast water management? Does it, the capex involved? Those ships are less fuel efficient than the new Eco design, and you have the more expensive IMO fuel. You're not going to put scrubbers on those ships. There's no room for it. So my personal feeling is that there will be a natural kind of attrition in that sector, which will tighten the supply. Any comments to that?
Yeah, I think you're right, and I think if you look at if you're inspecting 10, 15-year-old vessels, also maybe 18, 19, 20-year-old vessels for some reason, you will see that the maintenance for those vessels has not been extremely good, considering the market we've been through for the last 10 years. So adding then ballast water treatment systems of $700,000, which is not potentially a big issue in itself, when you add IMO 2020 and MGO fuel or 0.5% fuel as an additional cost, and you can't pass that through to the customers. I think we will see more opportunistic scrapping in chemical tankers that we haven't seen before, since we normally will own those vessels until they're 25 or 30 years of age. But now, approaching these regulations, I think we could see some accelerated scrapping, despite actually the market improving. So.
And I think relative to that, the typical market or buyer for that older tonnage is going to be, in the Far East, somebody that has a small sort of several vessel fleet. So I think when you're looking at the costs associated with ballast water treatment, the increased cost in fuel, I think given the size of some of those companies and the financing that they might be able to secure, it makes it more difficult, I think, for the seller to find an appropriate or willing buyer that sees the sort of economic viability of that sort of transaction.
And also adding to that, we're seeing the change of trading patterns here, with more U.S. Middle Eastern volume moving into Asia. I mean, that will replace Korean and Japanese older tonnage and short sea vessels. And they're also approaching their age or scrapping age closely. So I think we will also see scrapping to more specific type of vessels because they need to consider their options because their trade might disappear or shrink at the same time.
Yeah, thank you. When we put this panel together, we wanted to first lay the groundwork of what our chemical tanker trade is. And I hope we've done that, but this is a ship finance conference, so let's shift over to ship finance. There were 3 excellent panels that preceded this one that addressed bank finance, PE, and alternative finance, and also capital markets. So once again, that was covered quite well with those panelists and moderators, but let's talk to the specificity of the chemical tanker trade. David, you want to, or Kevin, you want to take this since you're a CFO? Funding the growth, for instance? Where's that coming from?
So I think, in many ways, we're one of the operator of the least sophisticated tonnage on the panel. We also have the least sophisticated capital structure. We're entirely financed with public equity and bank debt. I think, and hopefully this ties into the consolidation discussion earlier, I think the bank debt is going to be, traditional ship finance is going to be a major source of financing for those few companies that are large enough and transparent enough to appeal to the international banks that provide that capital. We continue to see ship finance as a big part of the future. And on the other side, we think there's a real opportunity for a leading public company here to tell this story that we've been talking about and that there is some excitement about in a meaningful and larger way. I think we're all challenged to be able to build the scale to make that happen.
David, you want to chime in on this?
No, I mean, I think I agree with Kevin. I think from our side, being having institutional investors involved with us, I think that's something that we continue continues to be a focal point for us. Certainly, the idea of consolidation and getting larger scale to have a meaningful size fleet that might be interesting to the public markets is something that we certainly discuss, but I think there's, the impediments that you mentioned before continue to be something that we struggle with.
Like I said, this was addressed in some detail on the previous panels. Coming from Chembulk, which was since December 1st, 2015, after the restructuring, after it emerged from restructuring of Berlin Leisure Tanker, owned by private equity KKR and Your Capital. But on that private equity panel, the general feeling of those panelists was that pure private equity, as we've seen over the past 8 years, let's say, certainly 6 to 8 years, that model is changing. I think Art Regan referred to a kind of a hybrid hedge fund debt platform mix as opposed to the straight private equity. This is toss-up. Anyone want to address that?
I mean, I think that's right. I think you're seeing a shift from private investors away from traditional private equity that buys a company and creates value over the intermediate term to more opportunistic investors that are purely looking at the cyclical play. And I think chemicals in particular, that's a bit more difficult to do because of the illiquidity of the assets. So in many ways, this sector is not as suited for opportunistic investment as some of the bulk trades, but there is still interest amongst that type of investor.
You're all publicly listed companies. I came from Stolt-Nielsen. I was there 11 years, and very much like Odfjell, much of their fleet were purpose-built, very sophisticated, high-quality ships, some of which lasted 30 or 35 years. Bjørn, I want to ask you, relative to the valuations and earnings, is it worth it?
Yeah, no, we've been trading. We've had our own issues over the time, but I think being publicly listed is something we will continue to be, and of course we want to utilize that as a currency at some point. Since our issues at our largest Rotterdam terminal, long story short, going from generating $50 million of EBITDA to minus $60 million of EBITDA, causing a headache for the company. Before that happened, we did trade at 1.1 times book. Since then, we've been trading at 0.4 times book. So there's a long way up to that, but we sorted out the terminal issues. And I think now everything we're waiting for is the market to actually pick up and also the investors to get that confidence that we can actually generate those returns across the cycle, which we've done before. I think the way we see it now, it is worth it, but I think from a valuation perspective, I can say it's frustrating. That's for sure.
What about the venue for a public listing? I mean, you're in Oslo, right, team? Team is in Oslo, right, Kevin?
Yes.
Yeah.
Both Odfjell and team are Oslo, and Navigate is OTC in Oslo. The Oslo market is very inexpensive to maintain a listing. Having just gone through an acquisition process and a prospectus process, and having had history with SEC processes, I got to say the way Oslo operates its capital markets is extremely efficient. So we continue to like Oslo as a listing, and we'll explore additional exchanges as hopefully we continue to grow.
So you answered my next question already, which was, is New York the only place to be?
Hey, Jack, I hate to do this to you, but with 2 minutes left, do you mind if I ambush you on something?
I guess I deserve it.
Now that you're an outsider, you have any unvarnished thoughts for the room on chemical tankers and the chemical tanker industry?
Well, I loved it. I absolutely loved the chemical tanker business. I think what was most exciting for me was the correlation of the cargoes we carried to all the way downstream to the consumer goods side. I remember, quick example, in 2007 going into 2008, the largest volume chemical that Chembo carried to China was methanol. And in 2009, that went to next to nothing. And we weren't carrying, not like the Navigate ships or Team with full cargoes of methanol. These were parcels, because that's the type of company that Chembo was. And the methanol was going into the production of formaldehyde, which is a resin used in the production of plywood, and of course plywood is used in housing. Well, we all know what happened in 2008 and 2009. There was no methanol moving. Very, very little. It went from one of the top volume commodities to one of the smaller ones that we carried. And why? Well, houses weren't being built in the US, plywood wasn't being built, manufactured in China. No need for formaldehyde, no need for methanol. So that was the thing that I always found so fascinating, was the downstream correlation to everyday life.
Thanks.
Okay, I think we're running out of time. We might have time for one quick question, if anybody has anything. Okay, well, thank you very much for your time.